Today, we're going to be talking about the 5 things that you must look for before you enter a trade to get the highest win rate. And I wish someone would have taught me this when I would have got started, because this would have allowed me to jumpstart my learning curve a lot quicker and allowed me to get to the next level a lot faster. And trust me when I say this, once you learn this concept, it'll truly transform your trading to the next level. So let's go ahead and break this down into 5 letters. These letters are MZEST, or in other words, MZEST. If you can apply these 5 letters into every single trade that you enter, you'll be trading a lot happier. So let's go ahead and get started. Talking about the first one, M, which is market structure, the very first thing that we must look for before we enter any trade is, what does the market structure look like? Or in other words, which direction is the market currently trending? Because the reality is, guys, we want to be trading with the direction of the actual trend, because the market can either go up or down. It can be bullish or bearish. It's a much safer play to trade with the direction of the trend rather than trying to trade against it. You want to look for the path of least resistance. There's a reason why there's a saying in the trading world that says the trend is your friend. If you see the market is going up, you want to be trading looking for buys. So if you ever encounter a situation like this, I'm on GBP CAD on the 4-hour chart. If you ever encounter a scenario where you might come to me and say, hey, Love Joe, I don't know if it's an uptrend or I don't know if it's a downtrend. I don't know which direction the trend is going. So I'm not really sure which direction I should trade in. Should I be looking for a buy or a sell? Because you can see the market here is trending down, and then the market at one point was trending up. So you might be like, Love Joe, which direction do I trade? And the way to find the direction that you should be trading in is, if it is unclear on the current time frame that you're currently looking in right now, you want to try to go to the next higher time frame to get a bigger and overall picture of which direction the trend might be trending in. So currently on the 4-hour chart, let's go ahead and move on to the daily chart. And I'll ask you this. You can obviously answer to yourself because I can't hear your answer over this YouTube video. But you tell me, which direction is GCAD trading? Are we looking for a buy or are we looking for a sell? Is the market trending up or is the market trending down? Obviously, you can clearly see that the market is indeed trending up. So in this case, you want to be looking for sell opportunities or you want to be looking for buy opportunities. If you're going to be trading with the trend, it is a wiser play to be trading in the direction of the trend. So the answer is you want to be looking for buy opportunities. Let's do another example. Euro AUD. All right, which direction is this trending in? It's very clear, very obvious. This is trending in the up direction. So the first letter, M, which direction should we be trading in? We should be looking for a buy, trading in the up direction. The market is trending upwards. The market structure is showing this is currently in a bullish market. Let's check another one. Let's try to look at GBP JPY. GJ. So we can look at this. We're on the daily chart. Which direction is this trending? Very simple, guys. Very clear. Right now, the market is trending in the up direction. So the market structure, what is it telling us? Is it telling us bullish or bearish? This is telling us a bullish market structure right now. And very important couple tips as a reminder. First one, if for some reason you're not really too clear of the direction of the trend in the time frame that you're currently on, always feel free to move on to the next higher time frame. The second thing is, if for whatever reason that you go to the higher time frame, smaller time frame, any time frame that you're in, that the market still seems a little bit choppy, and if you're ever in doubt, stay out. Meaning it's okay to not take a trade, sit out, maybe look at a different chart, maybe look at a different market, maybe you can find a better opportunity on a different currency pair or any different asset class that you're wanting to trade. So when in doubt, stay out. Hopefully that was enough information to cover the first letter, M, market structure. So let's go ahead and move on to the next letter, Z, or what I call zone of interest. Essentially, all this is once you've figured out which direction you want to trade in, the next thing we need to look for is any specific area of where we should enter the buy or where we should enter the sell. So in this case, this market is trending down. How do we know this trending down? Well, you can easily just kind of see it's going down, or to get a little bit more technical on you, you can just simply look at the highs and notice that the highs are in generally getting lower and lower. And what's happening with the lows? The lows are also in general getting lower and lower. This is a very clear indication of a current downtrend. So let me go ahead and clear all this out. Once we know which direction we should be trading in, the next thing we need to figure out any zone of interest of where we should be eyeing in order to trade. So which direction should we trade here? Should we be looking for a buy or should we be looking for a sell? Hopefully everyone here said we should be looking for a sell. So now we need to draw a zone, or we need to figure out, use technical analysis. Many ways to use technical analysis. You can use fibs, trend lines, zones, support and resistance, a bunch of different things. But for simplicity's sake, let's go ahead and use support and resistance areas. We can go ahead and grab the rectangle tool and go ahead and draw any zones that we see here. So this is a decent area. If the market approaches back up here, it would be a good area for a sell. Had we drawn this zone a few candles prior, this would have been a very easy, great, nice sell to enter here. So right now, obviously, this candle is already painted, so it's too late to enter a sell. So we can draw a zone down here. And question is, what would we do at this zone right here? Would we enter a buy and hope for the market to go up? Or would we not enter a buy? Would we still use this zone to instead enter a sell? It'll probably be a wiser decision to enter a sell. Why? Because the market is trending down. Remember, you want to trade with the trend. The trend is your friend. So as the market approaches this zone down here, you could be looking for a buy, or it is a safer play to rather look for a sell on this zone. And we'll go ahead and continue this replay tool. Okay, notice that the market breached that zone. So now we would use the same exact zone, which was once a support level, in order to find a potential resistance, and we can enter a potential sell on this actual zone. And that's just one example of just entering on a zone blindly, but throughout this video, we'll go a little bit deeper and get us a higher win rate that's going to give us a lot higher chance of success. That's just one example. Let's go ahead and talk about another example of zone so you can truly understand what I'm talking about here. So right now, guys, we're looking at CAD JPY. We're currently on the 1 hour chart again. So first question we need to ask ourselves is, which direction is the market trending? I would say this is definitely an uptrend. The market is trending upwards. Now, the next question we need to ask ourselves is, where do we want to enter a trade? Should we be looking for a buy or a sell? It's a wiser decision to enter a buy, but the question is, where should we enter the trade? So we can go ahead and draw a zone of interest here on this rejection area because the price went up, had trouble breaching this whole area, plummeted down, and then it has now pierced it, and it's on its way to come back down to this area again. So now that we have our zone drawn, we would know roughly where we would want to enter. So the question is, why do these zones work? The question we need to ask ourselves is, okay, if we know the market is trending up and we know we want to enter a buy somewhere, and we know right now the price has exhausted and is doing a quick pullback, we need to ask ourselves, where might opposing pressure come in? So right now, it's currently in a sell-off for the past few hours. Question is, when might the buyers kick in, and where on the chart could the buyers or the bulls be taking control? And that could be at this support and resistance area labeled right over here. And if you're someone who doesn't really like to use zones, or maybe you're just someone who likes to use fibs, you can even draw a fib from the most recent swing low all the way to the most recent swing high. And if you want to trade on the 23 fib, that can also be an indication of where you want to enter your buy. Or if you're someone who uses moving averages, you can use moving averages as dynamic support and resistance as well. I'm not going to get into that in this video. I'll share another video on that on this channel as well. But again, there's many different ways and many different opportunities you can use in order to find a zone of interest. And if you are someone who uses multiple factors such as fibs or even support and resistance areas, and if you find a specific sweet spot where multiple technicals line up, that will give you what's called a confluence that could give you a higher probability setup that the price might be reacting in this area and bullish pressure might come in. Why? Because if some traders don't use support and resistance and those other traders only use fibs, they might be also eyeing this 23 fib just like you. But what we're doing, we're confluence traders. So we put multiple different technical factors in our favor to give us a higher probability setup, a higher probability trade if we can find an area where multiple technical factors are lining up. There's the entry, and then there's our trade. So now let's talk about the next letter, which is E. This stands for entry trigger. So this essentially, what we're doing is we're trying to figure out what is going to give us the green light to enter a trade once the price enters our ZOI, enters our zone of interest. So for example, the first thing we notice is M, what is the market structure? It is going down. So the next question we need to ask ourselves is, where should we be looking for our trade? What is the zone of interest? And it is right here. So we know we should be looking for a sell. We know we should be entering possibly somewhere over here. The next letter, E, our entry trigger, the question we need to ask ourselves is, when should we enter? Because like I've shown you in the other examples, which were indeed cherry-picked to show you those examples, the price could just as well go the other way and it might not be a good trade. So in order to get the highest probability wins, we could wait for what's called an entry trigger. Because if, just like the other examples, if we just blindly entered a sell on this zone because we see the market is trending down and we have our zone created, it doesn't mean that the price is going to go in our favor. So we will go ahead and continue. And by the way, guys, as you can see, this would have completely blown past our stop loss and this would have been a losing trade. So the question is, what is an entry trigger? And this can be a few things. The first thing it can be is it can either be a candlestick confirmation, or in other words, it can be a price rejection, or it can maybe even be a break of structure. Or lastly, if you draw technicals, you can look for a trendline break as well. All of these will give you an entry trigger in order to enter your trade in the direction of the trend. So let's talk about some examples. So right now we are currently on Euro USD on the daily chart, and we clearly see that the market is trending up, or is the market trending down? The answer is the market is trending down. So we have the first letter checked off. The second letter is the ZOI. Which zone are we looking for? So we know we want to enter a sell and we've drawn our zone. We've check marked the second letter as well. So the question is, when should we enter this trade? Or should we even enter this trade? We need an entry trigger, and that could be a candlestick rejection. So let's go ahead and do this one by one and kind of see when would be a good time to enter if we are even going to enter this trade. Because if we enter directly in the zone without waiting for anything, it could very well, just like the previous example, continue to go up. And trust me, we were pretty scarred from that loss. So let's not try to have that same type of loss by blindly entering these trades. So let's go ahead and go candle by candle. Okay, so we could enter here if we did it the way that we did in the other example, or we can wait for a candlestick confirmation. What we're currently seeing, we're seeing a very bullish candle, which created a wick at the top. The price is, at this point, rejecting this same area, which was once a support. It is now resisting to go any further. This is another rejection candle that we see here. However, it is still green, so this could show a little bit more sign of bullishness. So it would be a little bit wiser to wait for another candlestick confirmation. Okay, this is a red candle, a very bearish candle. Notice this candle actually closed towards the bottom of the actual candle. It didn't have a huge wick at the bottom. It closed all the way down. And the next thing we actually notice is that this is a bearish engulfing. Notice that this red candle is engulfing this green candle. It is a lot farther down than where this one actually started. So this green candle started right here, and this green candle ended up here. The red candle started here, and it ended way below here. This would be our entry trigger. So we would go ahead and now enter our sell position, and now we have our entry trigger activated. So, and then we will go ahead and continue. So let's talk about another example. We are currently looking at Euro NZD, and we see that the market is currently trending up. Well, we need to find an entry trigger. So we could be looking for a potential trend line break. So we know this is trending up, but at this point, the market temporarily was trending down, but the overall trend was indeed up. It was a bullish trend. So once this bearish momentum finishes, once this trend line ends up breaking, it's being held very strongly, but once it ends up being broken, this would give us our entry trigger in order to enter a buy. We would wait for the candle close depending on whatever time frame that we're on, and that would give us a entry trigger to start entering in the direction of the trend. So let's talk about another example. Right now, we're looking at GBP CAD on the 4-hour chart. And if you're someone who doesn't really use trend lines and you're more looking at market structure, we can kind of identify a few things here. So I'm just going to use this little circle tool. And we notice that the overall trend during this time period has been an uptrend. Why? Because you can notice the highs are getting higher and higher and higher and higher. And the lows are doing the same exact thing. The lows are getting higher, 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 and higher, etc. But at one point, the highs started getting lower. The highs started getting lower and lower and lower and lower and lower. So we would wait. Our entry trigger would be a break of structure. Right now, the overall structure is bullish. The small temporary structure is bearish. And we know this because the highs are getting lower. We're having lower highs, lower highs, lower highs, lower highs, lower highs, and it's consecutively getting lower. So what we would want to wait for is a break of this lower high structure. We want to wait for a higher high, meaning resuming this main trend. And that is indicated right here. This would be the next higher high. Now we would know this is where we need to start looking for a buy because the buyer's momentum is continuing strong. Okay, so let's talk about the next letter. This is S, which is your stop loss. So it's very important that you identify where you would want to put your stop loss before you actually enter the trade. We need to define an area where if the market reaches at a certain point of price against us, where would that invalidate our trade idea? Or in other words, we need to ask ourselves is, where on the chart will the market prove us wrong for our trade? So in this case, we are looking at Euro JPY on the 4-hour chart, and we see that this is a bullish trend. So the market structure is a bullish market structure because it's creating higher lows, higher lows, higher lows, and higher highs, higher highs, higher highs, and higher highs, and higher highs. And we have our zone of interest created. So now we're waiting on our entry trigger. And then once we have our entry trigger, we will activate the trade while also simultaneously looking for an area of stop loss. So let's go ahead and paint the next candle. Notice it was a very bearish red candle, yet it had a huge, massive rejection wick, and it ended higher than the previous candle. So this is our candlestick confirmation. We waited for this candle to close. Instead of entering right on the time it touched it, we waited for the candlestick confirmation, waited for it to close, and now we have our actual entry for the buy. Question is, where should we put our stop loss? My question to you is, if the market comes down to this area, if the market comes back down, is our buy, is our trade invalidated? Yes or no? Answer this question to yourself. Is it invalidated? The answer is no. The trade idea is still not invalidated. If the market ends up coming down to here, is the trade idea invalidated? The market continues to go down. Is this where we would lose the trade? The answer should be no. Newbie traders will put their stop loss at the zone, and that is the wrong thing to do. What you want to do is you want to put it in an area where the trade will get absolutely invalidated, and that is below the zone. You want to put your stop loss below all of these little wicks here, below these wicks. if you have your stop loss past the zone, this gives you enough breathing room to allow your trade to continue in case the price does end up coming back to this zone. You will still be in the trade and you won't lose money unnecessarily. Okay, so let's do another example. Let's do a little bit one that's a little bit more challenging. So right now we're actually on CAD CHF on the 1 hour chart. So the first question we need to ask ourselves is the market structure. Are we currently in a bullish trend or a bearish trend? We can notice that the market structure is creating lower high, lower high, lower high, lower high, lower high, lower high, and sitting with the lows, lower low, lower low, lower low, lower low, lower low, and lower low. So this is a bearish trend, so we should be looking for a sell. Question is, where do we draw our zone of interest? We can clearly see that this is a downtrading market, so we can even draw a trend line. So draw a trend line from the top, connecting all these little wicks here, trying to encapsulate as many wicks as we possibly can. And our zone of interest would be somewhere along this trend line. So now we need our entry trigger. We'll go candle by candle. It pierced it. Okay, and then now we see that it had a huge candlestick rejection. This is a shooting star candlestick, which means this is getting some selling pressure. So this could be an area, if you were a little bit more aggressive, you can have an entry of a sell right here on this candlestick rejection. So we can go ahead and enter a sell position. The question we need to ask ourselves is, where should we put our stop loss in this scenario? Should we put our stop loss somewhere, just anywhere above the trend line, because that might invalidate it? Or should we put our stop loss here? Or should we put our stop loss here? I'll tell you one thing, this would not be an ideal area to put our stop loss because the price has already wicked up here. So we would definitely need to put our stop loss above, at least the bare minimum, at least put it above the last previous high wick. The next thing, should our stop loss go way up here? I feel like it's way too lenient. This is not going to give us a good risk to reward ratio at all. So the best Goldilocks zone of the stop loss would be anywhere past this wick, giving enough breathing room for this trade to actually go in profit. And in case the price does wick up, it won't invalidate the trade because it should at least be under this wick. All right, guys, let's talk about the last one. We are currently on the final stretch. So let's talk about T, which stands for take profit. Once you have everything created, we need to ask ourselves the last question is, if the trade does end up going in our favor, where should we take profit? So the first question we need to ask ourselves is, are we looking to simply enter a trade as a swing, or are we looking to enter a trade and ride the trend indefinitely? Once you have the answer of those two questions, we can figure out what type of take profit structure we want to take. If you are looking to ride the trend, what you can do is you can employ no take profit, and instead you can actually use what's called a trailing stop. And what that does is, that is simply a dynamic stop loss that moves along with you as the price, I'll make this a little bit thick so you can kind of see it, as the price continues to increase, the stop loss will automatically keep creeping up higher and higher and higher, but it won't go down any further if the price does end up retracing. And what this does is, if the price ends up going up quite a bit, and it keeps going up and it keeps going up and it keeps having small retracements, what this dynamic stop loss will do, this trailing stop will continue to trail this trend how many ever pips that you decide. So you can decide to trail it by 10 pips. You can decide to trail it by 50 pips. You can decide to trail it by 80 pips or even 150 pips. And it'll keep trailing it. It'll keep going up and up and up and up, higher and higher, until the price finally does end up coming back down to those 10 pips, to that 50 pip mark, to that 80 pip mark, or 120 pip mark, or however deep that you made the trailing stop. And this will essentially allow you to ride the trend indefinitely until the price ends up retracing back to the trailing stop. That's one way. The second way to do this is to define an area where you would want to enter your stop loss. Maybe you don't want to wait for the market to retrace. You're looking for an area where you just want to ride a swing, maybe at an area where you feel there might come in some opposing pressure. So in this case, we're currently in a buy. We need to figure out where can there be some opposing pressure coming in to prevent this from going even higher. A couple different things we can look at. First thing, we can draw this trend line over here, connect all these highs, and we can say, all right, there might be some selling pressure if the price approaches this trend line. That might be an area to close our trade because it might have a probability of reaching it and then just bouncing back off. And this way, instead of losing money as the price comes down, we can try to capture the optimal exit. So that's one way. Another way we can look at our take profit is by drawing zones. So if there's an area where the price rejected previously, this could be an area where the price might have trouble breaching. Or if that's not the case, this could be another area of take profit. Or if that's not the case, this could also be another area of take profit. And you want to extend these zones all the way to the right because these might be areas where the price might react. So if you're a little bit more conservative, you would obviously have a take profit a little bit closer to the current entry, in this case around 300 pips. If you're a little bit more aggressive, you can have a little bit farther take profit, or if you're a little bit more aggressive even more, you could have an even farther take profit, let's say around 600 pips. And the way to determine how aggressive should be comfortable for you is all it is it's just by doing many trades. Do many conservative trades, and over a course of maybe 50 to 100 trades, see if these take profits are legit areas where the market is actually busting a U-turn and coming back down. So that might be the optimal. Or if you find every time you put your take profit a little bit conservative like this, and if you find that the price more often than not always breaches it and goes even further, then start testing out a less conservative take profit. And then if it usually ends up going even further, and the only way to track this is to journal your trades and track your entries and track all your trades, and then if it breaches that too, more often than not, then you can have an even more aggressive take profit. And the only way to find this out is just by doing multiple trades and seeing what your risk level is. Aggressive take profit ended up turning a U-turn at this zone. Why? Because this is where the selling pressure was. As you can see, it's been a long time where the price had reached this area, and this was a nice area to put our final take profit. All right, guys, let's do one final example to bring everything home, and we'll go ahead and go over all of the different letters, and we'll conclude with this trade right here. So the first question we need to ask ourselves is the market structure. Are we looking for a buy or are we looking for a sell? We'll go ahead and click that handy dandy little happy face and click our circle tool, and we'll notice the lows are getting higher and higher. And what's happening to the highs? The highs are getting higher and higher and higher as well. So we should be looking for a buy, or should we be looking for a sell? Should probably be looking for a buy. So next question we need to ask ourselves is, what is a zone? What is the zone of interest? The zone, we can draw a support and resistance area just right over here. It could create a double bottom, and in fact, connecting this zone even further back, notice what is now a support was at 1.8 resistance, and goes back even further as another resistance area. So we know we're looking for a buy, and this is our zone of interest. So now we need to wait for our entry trigger. So we'll take candle by candle and see if we get any candlestick confirmation that is showing that the price might go in our favor. Very bearish candles right now. Had a great rejection wick actually. So this is showing good sign of buyers coming in and rejecting at this area right over here. Let's see what the next candle does. Our first green candle in a sea of red. So if we are a little bit more aggressive, we can enter right here because this shows two candles that are representing good buying pressure. This hammer candle, which is still red, and then the next candle, however, is green, which is showing some buying pressure. Or we could be a little bit more conservative and just wait for the next candle. Let's kind of see what the next candle shows. Okay, this shows bullish pressure as well. So now we have our entry trigger, and we will create our long position. Where should our stop loss be? Should our stop loss be here? Or should it be below the zone? Hopefully at this point, I've drilled it enough into you that it should definitely be below the zone somewhere. So put it below the zone. We have our stop loss. So now we need to figure out where should our take profit be. And let me give you another bonus small little tip here. Whenever we're looking at these different areas of take profit, like the previous example I gave you, we had multiple different take profit areas. You can also, as a pro tip, you can also take what's called partial profits in different areas. Meaning, if you see one area where the price might reject, what you can do is, if you have, let's say, like a 2-lot trade, you can close half of that trade and then take some profits off the table, and then have just 1 lot remaining continuing to run to maybe your second take profit, or maybe even your final take profit, or maybe you can even have the other remaining 1 lot trade running using a trailing stop. So maybe you want to collect at least partial profits at a specific area where you're predetermined, and maybe you want the rest of the trade just to run indefinitely until it ends up inevitably hitting your trailing stop. So let's find some areas where we can do some partial take profits. So one area, which is a clear rejection area, the price action had trouble reaching this area twice. That could be an area of take profit. And we do see this as an uptrend. So another way we can do this is we can even draw a trend line connecting all these highs. And since it's rejected this trend line multiple times, the next time it approaches that area, it might also have trouble breaching that area the next time. All right, so now we have our trade activated. We have our stop loss set. And then we have our, actually, I'll just draw it here. We have one take profit on this zone. And then the second take profit, which is constantly going to be changing, is constantly going to be getting higher the farther in time that we go across this trend line. So this is just somewhere up here for now. And then we have both of these stop losses for both of the trades in the same area. Notice it's 2 separate stop loss or take profits. First take profit got hit. So in other words, we closed half of the trade. Price hit the trend line, which means we've closed the entire trade in full. All right, guys, so that pretty much wraps up the 5 letters, the MZEST, in other words, MZEST. Make sure you try to employ every single one of these letters into every trade. You want to pre-plan your trades before the market touches your entry. You don't ever want to jump into the water to catch fish because you know the fish will swim away and you're not going to be able to catch any fish. Instead, you want to throw your reel into the water. You want to wait for the fish to nibble on the reel. You want to wait for the fish to come to you, and it is at that moment when you strike to get yourself the highest win rates. What I've shown you here is a little bit conservative. We're waiting for the candlestick confirmation. We're waiting for our entry trigger to get activated. But what this is going to do in the long term, this is going to reduce the amount of losses that you get, and it's going to get you a lot higher win rate so you can stay in this game longer and actually start growing your account. And at one day, you might be even able to get to a level where your trading income is at the same exact level as your normal 9-to-5 job. And at one point, get your trading income to even double your normal job's income, and even get to a point where you're making mid 5 figures a month, and get to a point where you're making 100,000 plus a month. It's not going to happen overnight, but as long as you start doing the right things, even with your small, normal, adjusted account balance, if you keep doing the right things and you keep having the right habits, no matter what your account size is, those small good habits will translate into a time whenever your account is a lot larger. So if you found this helpful and maybe you're in a trading group or maybe you're trading with some other brand new traders that are trying to grow just like you, feel free to share this video with them so they can also learn as well. And if you did find it valuable, feel free to drop a like on this video and subscribe to the channel if you haven't subscribed already. I'm uploading videos just like this on a constant basis, and you don't want to miss out on the next training I release completely for free here on YouTube. And if you're someone who wants a little bit additional help, there's a link to our private program in the description below. You can click on that link and you'll get a lot more information regarding that as well. That being said, take care, and I'll catch you guys in the next video. Take care, guys.